All right, yield nerds, episode 118. How about that? We're getting up there in numbers. I have two very exciting messages. One is to buy helmets because the sky is falling. And the second is I have discovered another NVDA. Believe it or not. Just kidding. Well, we are up to 291 subscribers, and we're getting there and approaching the 2 year mark. So I'm very happy about that. If you're new to this show, please remember to use the playlist called the Income Investing Roadmap. And by the way, I have no magical powers of prediction, and that includes the silly statement that I have discovered another NVIDIA. I just stumble upon things, I share my knowledge, and you make your own decisions. Please make sure to double check any information here. Well, let's kind of look at today's agenda. I put it as four parts. One, I'm officially crawling under a rock, and I will explain more. The second is if I were to come out of said rock, I look at what the next available options are and share my education on that. And then I will tell you this other equity that walks, talks, and quacks like the early day NVIDIA to me. And you may look at it in other directions, and that's up to you. And then my next steps. Well, let me give you the drum roll of why I think I am crawling under a rock. And all of you know by now that I am very heavy into fixed income. It's getting ugly, people. I am now 99.13% into fixed income. How about that? So my equity allocation, my lunch money allocation is truly, truly less than 1%. And even within my fixed income, it really has two large classes. I do have a substantial portion of my fixed income allocated to the ETF called SRLN. And at the right time, I'll get out of that as well. But for now, it gives excellent dividend income. It stayed fairly flat for the last year, which I'm happy about. And within the remainder, the 80 something percent of my fixed income portfolio, I pretty much have a very large percentage of it maturing within 60 days, and more than 80% of that maturing within this year. And the way I think through it, anything over 3 years or in callable agency bonds at 5.5, 6% plus state tax free. In the 1 year mark, there was a period that I extended duration, and these are treasuries that will still be around when interest rates drop. I don't know when. It could be 3 months, 6 months, a year. And when interest rates do drop, I expect these treasuries to kick up because these pay a fixed 5%. And if interest rates drop in the short term, the longer or medium term duration treasuries should go up, and I probably will sell them at that time. And the rest of my investments in fixed income all sit in really short term, state tax free treasury bills. Well, I kind of had to step back and say, if that is where I am, 99% in fixed income, what are my other options? If I were to crawl out of that rock, where else can I look? Is the sky really falling? And so I use this fancy concept called BATNA. BATNA is the best alternative to a negotiated agreement, meaning if I've decided fixed income is my jam, what are the next best alternatives? And I started looking at it, and I'm going to share my education. Please remember to do your own due diligence. Sean, one of our listeners, pointed out an error in my previous episode, and he said, hey, it's not the fund manager that is messing around with ETF prices on dividend days. So, Sean, thank you. So, if I were to go outside of fixed income, what are the other asset classes? And again, these are my personal opinions. I suppose I could go buy the metal, gold and silver and so on. My 2 cents, and reasonable people can disagree. I don't like buying just the metal. The metal doesn't do anything. You're just betting on the price going up or down. I like makers. I like factories that do something with the gold. Signet Jewelers is very interesting to me because they buy the gold, keep it in their store, even though they are not selling a lot. If the price of gold goes up, then their inventory value goes up. How interesting. I'm not saying I own Signet Gold, I do not, but it's somebody like that which interests me and not the metal itself. Commodities, I suppose I could go buy cocoa. Cocoa is trading at an all-time high, and I could sit here and say maybe it's going to go even higher. I don't do that. I do have oil and natural gas, but I don't bet on the price of a barrel of oil. I buy people who make things with oil or who ship oil. I suppose I could look at crypto and Bitcoin and grandma's rare dolls. It's just not my thing. You do you. Real estate is something that is very good to hold during inflation. Given what I see today, there is very little supply, demand is too high, prices are high, interest rates are high. I'm just kind of waiting. I think there's probably an opportunity coming there. I just don't know when. So that pretty much brings me back to if I were to kick up my allocation in anywhere except fixed income, it ought to be equities. And so I'm trying to think through where do I go? And that is where I started looking at, this is a Schwab asset class screen and looking at equities across all sectors. And as you can see, in general, there are some sectors that have absolutely done very well year to date, except all of them, practically all of them, are in the red in the last month. You have to sit there and say, gee, why is everything in the red except, energy and utilities? And I will not be commenting about the communication services. That has to do with a certain SPAC that has been in the news, and you do your own research on that. But energy and utilities are the only ones in the green in the last month. So I'm a little gun shy about jumping into equities at this point. So that kind of alarms me. So I started looking at, gee, are there equities within these sectors that are bucking the trend? If so, who are they? And is there anything for me to look at? And that is when I went to my favorite sector, food and energy. And within food, I discovered something that shocked me. And this, my wonderful listeners, is the next NVIDIA. At least that is how it seemed to me initially. Somebody is emerging within the food sector that is going to challenge my notion of thinking. And I started looking at the Magnificent Seven, and I said, the Magnificent Seven is doing well, but should I be looking at growth within the Magnificent Seven or the value industry instead of only looking at dividends and fundamentals? Is there a growth stock? Is there an NVIDIA, so to speak, in food and energy? And surprise, surprise, I stumbled upon an NVIDIA-looking stock within food and energy. Look at that. They are going vertical. Just this year to date, they are up 80%. Absolutely amazing performance. And I started digging deeper. And turns out it is an egg maker. You sit there and go, wait a second, an egg maker growing at 60% on stock price just this year? Who in the world is that? And here is the boxing match between eggs, and they're betting a lot of money on it, and the chicken are cheering. So that is the mode. It is the NVIDIA of eggs emerging in the market. And I'm not yet telling you who that company is, and I will do the reveal here shortly. But you look at their SEC statements, and they say, we sell shell eggs, exactly what Cal-Maine does, except we are the premium eggs. And so we specifically go there and mark up our eggs on top of the commodity eggs, the cheap eggs. We are the expensive eggs. And we want to make sure you understand that, our supply could be constrained, but we increased our prices during 22, 23, 24. Think about it again. Egg prices came crashing down in that time. Cal-Maine Foods earnings went nosediving. And here is a company that says, we are bold, we are the premium egg, we increased our prices. And they are saying when we increased our prices, we didn't even see significant decreases in sales volume. You read that and go, whoa, whoa, whoa. They are making Cal-Maine look like Intel, and they are the NVIDIA of eggs. They show up with this premium product, and they increase prices, and they are crushing it. This is from their 10K. And then you read more, and this is from their annual report. You see numbers like this. This is a hockey stick in the number of stores that carry their eggs. Their revenue is a hockey stick. Their profit is a hockey stick. OMG. Is that the next NVIDIA? And then they tell you more. Our products are sold at Albertsons, Kroger, Publix, Target, Walmart, Whole Foods. You sit there and go, 24,000 stores around the country carry our premium eggs, and people can't stop buying it. And they have the gall to compare themselves against Cal-Maine Foods, and they tell you they are stealing market share and they are making huge margins. Look at this. They do have a premium peer group, which is the yellow, and then they have the conventional group, and they are able to charge a huge markup over both their premium peer group and the conventional peer group. So they are making money hand over fist. And here's the crazy part. Not only are they making money, they are stealing market share from competition, which includes Cal-Maine Foods. You sit there and go, this must be the really cheap coffee. And then Starbucks shows up. And this is the new Starbucks. This is the new NVDA. OMG. And they show more proof. Their EBITDA is going through the roof. Look at that. So they are kind of, 2017, 2018, 2023, their EBITDA doesn't even fit in that chart. And so it is absolutely demolishing expectations. And you have to go back and check NVIDIA and say, how did NVIDIA do before they popped? Ironically, same story. NVIDIA's quarterly growth of free cash flow was anemic, and all of a sudden, NVIDIA hit a point where people started adopting artificial intelligence. NVIDIA didn't have to do more marketing, and they just sat back and collected the cash, and their free cash flow went through the roof. And you sit there and go, wait, how is the quote NVIDIA of eggs doing? And their free cash flow used to be very, very negative, and the hockey stick is turning positive. Who is this NVIDIA of eggs? And you look at their stock and you start comparing it to JB San Filipino, which makes Planters peanuts, and it's not even on the same chart. Cal-Maine Foods is languishing on flat. JB San Filipino is going low, and this company, the NVIDIA of eggs, and I'm going to reveal who they are here, they are absolutely obliterating competition, selling premium product, grabbing higher net margin and a higher market share. Who is this? The egg drop. This new champion is Vital Farms, VITL. They do trade on the NASDAQ, and you sit there and go, how are they able to do this? What is their prospect for a future? So I got very excited about it, and I compared them to Cal-Maine head to head. Well, Cal-Maine does have double the net profit, but hey, who needs profit? This is, the growth stock. We should be excited. And Cal-Maine does have higher return on assets, and they have a higher return on equity and a higher return on investment. But look, it's a growth stock. We can tolerate it. And then you look at valuation. Earnings per share, Cal-Maine has 10 times the earnings per share. Just stop looking at stupid numbers, will you? Price to earnings ratio. Hey, how about that? The PE ratio of VITL is the same as NVIDIA, 45. Cal-Maine Foods is 10. And price to forecasted earnings pushes it even farther out. And you start looking at this and you have to sit there and say, wait a second, $1 of cash flow in Cal-Maine, you pay $3 for it. $1 of cash flow in Vital Farms, you pay $30 for it. It does look more like NVIDIA in more ways than one. Except you have to come here and salute Vital Farms. Earnings per share grew by 3,000% last year. And over here, it fell. So Cal-Maine had lower earnings because their prices decreased. Vital Farms went from a teensy-weensy amount of earnings to 3,000% increase in earnings. So that is what is propping up their stock. They're finally turning a profit. They're throwing free cash flows, and everybody's getting excited about it. And you look at the actual profitability itself, you can see that the gross profit of Vital is significantly higher, 30% higher than Cal-Maine Foods. However, they're spending a lot of money in marketing, and therefore their net profit margin is actually barely, half of Cal-Maine. So you have to sit there and say, is there an AI equivalent? Is the entire market suddenly going to go to premium eggs and Cal-Maine is going to sit there and watch it like Blockbuster while Netflix entered the market? If your assessment is that, oh my goodness, Vital Farms has figured it out, Cal-Maine is going to sit on their thumbs, do nothing, then this might be one for you. Cal-Maine has no debt. Vital has a little bit of debt, nothing too crushing at the end of the day. So the egg wars have begun. Cal-Maine has a real competitor. You have to decide whether this is an AI moment for Vital Farms. Let me know what you think. And I'll go to my own next steps. As far as my own next steps are concerned, it's pretty simple. I did mostly stay in treasuries, as I always do, and I bought more Cal-Maine foods. I guess I'm telling you what I think of Vital versus Cal-Maine. And in terms of the rest, I did sell all of my BISD holdings, and I'm kind of hiding under a rock. So, with all of that said, I am very, very heavy in short-term treasuries, and the rest of it, I'm just watching what happens in the market. You do you. I'm going to sit here and say, whether there is inflation or not inflation, our ability to price shop is going to be limited. There are certain categories, apparently luxury eggs. I didn't know there was such a thing. Apparently, our ability to price negotiate in certain areas is not very strong. I seek out those areas. There probably will be an interest rate, cut later this year. Maybe, maybe not, but I'm staying very short term. And there are other factors that worry me. But at the end of the day, aside from speculating with lunch money, I am pretty much on treasuries very short term. You do you. Remember, even a blind squirrel finds a nut once in a while. Thank you for your comments as always.